Ask 10 serious investors what they'd hold for the next 20 years, and the same few names keep coming up. Not meme stocks, not whatever's trending this week. A small handful of ETFs that long-term investors genuinely can't stop talking about. Now today I'm breaking down 3 of them. The first owns basically the entire market. The second almost nobody's heard of yet, and it might be the most interesting of all. And the third is built to pay you along the way. Now I'm going to show you what each one is, why people love it, and the catch nobody mentions. And by the end, you'll understand all 3 better than most people ever will. Now, real quick before we get started, I'm not your financial advisor, and this isn't financial advice. These aren't recommendations. I'm just breaking down what these funds are so that you can think it through for yourself. Section 1, the whole market one, VOO. Start with the most famous one, VOO. VOO is Vanguard's S&P 500 fund. In plain English, it owns a piece of the 500 biggest companies in America, all in one basket. When people say just buy the index and chill, this is usually the thing that they mean. Here's why the long-term crowd loves it. It's simple and about as cheap as investing gets. And instead of betting on one company, you're spread across the biggest ones in the country. For decades, that approach has been hard to beat with anything more complicated. But here's the catch nobody likes to mention. When you own all 500, you own the good and the bad, the dominant businesses and the ones limping along. And because it's weighed by size, you automatically own more of whatever's already the biggest, whether or not it's still a great business. So VOO is the safe, boring default. A lot of people are happy stopping right here. Just know that owning everything means owning the losers too, because it gives you the whole market in one click, dead weight and all. But the next fund was built to do the exact opposite, and it's the one that I've been waiting to show you. Section 2, the dominator one, MPLY. Now this is MPLY, the strategy shares Monopoly ETF. It's built on a completely different idea from a normal index fund. It doesn't try to own the whole market the way VOO does. It's built to own only one specific type of company, the dominators. Businesses that run their markets so completely that competitors can barely touch them. Think about the company whose software runs on nearly every office computer, or the network that takes a small cut of what feels like every card payment on earth. These are the toll booths of the economy. Everyone else has to pay to pass through, and they just sit there and collect. MPLY is built to hold a basket of those kinds of businesses, names like Microsoft, Visa, MasterCard. And here's why this one's interesting for a long-term hold. The whole point is to skip the average companies and own the ones that dominate. Instead of owning all 500 and hoping the winners carry the losers, you're trying to own mostly winners in the first place. And the catch, because every one of these has one, it's concentrated and it's newer, so it doesn't have the decades-long track record something like VOO does. Nobody can promise you how it will perform. That's just the truth. But as an idea, owning only the dominant businesses is about as compelling as it gets for someone thinking in decades. Now, if you want to see this one for yourself, it takes about 30 seconds. Open whatever brokerage app you already use, Webull, Robinhood, Fidelity, any of them. Search those 4 letters, MPLY, and you can see every company inside it. That's the growth side of the story. The last fund on this list does the complete opposite. It pays you just to hold it. Section 3, the dividend one. SCHD. Now the last one is built for people who want to get paid to hold. SCHD, and it stands for Schwab's Dividend Fund. Instead of just chasing growth, it focuses on established companies that pay dividends. A dividend is basically the company sending you a cash payment just for holding the stock. Here's why the long-term crowd loves this one. You're not only hoping that the price goes up someday, you're getting paid along the way, and you can reinvest those payments to buy even more. For people who want income or who just like seeing money show up on a schedule, it scratches an itch a pure growth fund doesn't. But here's the catch. A fund built around dividends usually isn't built around maximum growth. You're trading a bit of the upside for that steady payout. It's a different goal. Income and stability more than swinging for the fences. So SCHD is the one for the get paid while you wait crowd. Whether that fits depends on what you actually want your money doing. Now look, the people who do well over decades usually aren't the ones chasing the hottest trade. They pick an approach they understand and they stick with it. VU if you want to own the whole market. MPLY if you want to own only the businesses that dominate. SCHD if you want to get paid while you wait. 3 different bets on the long game. All 3 worth understanding before you pick. All 3 up in your brokerage and see which one actually fits how you think about money. Now, if you found this useful, subscribe and I'll see you in the next one. Oh, and by the way, this video is for educational purposes and is not financial advice. Investing involves risk, including possible loss of principal. See you in the next one.